Welcome to Chapter 4 of the Wealth Management Essentials course. In this chapter, we will be looking at assessing the client's financial situation and looking at net worth statements, cash flow statements, and introducing the time value of money formula. So for the learning objectives, there aren't too many. As I mentioned, we will look at net worth plans or statements, cash management and cash flow statements, also outlining the saving strategies for a client, and look at the time value of money formula. So to start, we're going to look at net worth. So calculating net worth, it is fairly straightforward. It is your assets minus liabilities. So you would have liquid assets. That could be things like cash in your bank account, investment assets like RSPs, TFSAs, that sort of thing. Those would be your liquid assets. You could even consider maybe a car a liquid asset, or a valuable painting, anything that you can sell in a relatively short time period, whereas a house would be a fixed asset. It takes a bit longer to dispose of, and so it would be a fixed asset. You then look at your liabilities. So you might have some short-term debt like credit cards, maybe a line of credit, and then a long-term debt, which could be a mortgage. So when you're looking for your net liquid assets, it's just your liquid assets minus your short-term liabilities. Same with fixed assets, it's your fixed assets minus long-term liabilities. And just calculating the total assets minus the total liabilities gives you your net worth. Next, we'll take a look at cash management planning. So when you are planning just cash management, you can sometimes look at a cash flow statement to figure out if you're bringing in extra money every month or you're spending more than you're actually making. So when there is insufficient cash, when you have a negative cash flow, you have a few options. You can reduce expenses, you can increase earnings, you can delay when you need the money, or you can increase the rate of saving or growth. So we will look at some cash flow statements that just help plan to control spending and ensure liquidity. So we'll look at that now. So with this cash flow statement, again, it's pretty straightforward. First off, you look at your income from all the different sources. So Jim and Helen, both $75,000 of income. Then you look at their expenses. So they're paying some money towards tax, and then they have various family needs like home, insurance premiums, payment on other debts, that sort of thing. So you look at the income, you subtract all the expenses, and then you come up with the cash flow. So in this case, it is a negative cash flow. There is more expenses than income, and so the net cash flow is negative. Again, if you were looking to fix this, you can either you can reduce the expenses, increase your earnings, delay when you might need the money. So maybe you take on some debt and that's income for that month. That definitely creates a problem later on down the road. And then finally, you can potentially increase your rate of growth on the investments. Maybe you can get more out of your investments. And so the cash flow statement, it does come into play a lot when you are doing retirement planning, just trying to figure out how much income someone might need. It is good to do a cash flow statement or a budget just to show the inflows and outflows for that person and how much money they might need to cover those expenses. Next, we'll take a look at some saving strategies. So there are 4 different saving strategies. First, you want to set a realistic goal. So if you have someone that is barely getting by, you wouldn't want to suggest to them that they should save 20% of their cash inflows. It just isn't a realistic goal. You know, they are barely getting by. They're not going to be able to save 20% of their income easily at all. So you want to make your goals realistic. Usually if you have someone that's starting out or that is starting to invest, maybe just start off with a modest amount, something they know they can do. It could be $50 every paycheck or $100 a month, or just something fairly small And as they become comfortable with that, you can then suggest to slowly increase that to help them meet their financial goals. Second is set up an automatic savings plan. So I did just talk about that. If you do just set up a small one to start with, it really does help the person build it into their budget. So that is a great way to just automatically set up that savings component, and eventually they won't even realize that it's there, and it'll just become normal to them. Next is resist buying on credit. So this is especially important when interest rates are quite high. Having credit, it does decrease, or if you buy something on debt, it can sometimes decrease your net worth, especially if the interest rate is quite high and you can't seem to get rid of the debt. So buying things on credit, it can sometimes make sense if interest rates are low, but more often than not, try not to, especially when the interest rates are high. Finally, reward yourself. So that's sort of the concept that you don't want to be saving all of your money away, and it is okay to reward yourself and go on a trip every once in a while. The next topic is emergency savings. So a lot of people like to have some sort of emergency savings. There's a general rule where some people say you should have 3 or 6 months expenses just as an emergency savings. And there are various ways to do this. Some people like just having it in a savings account. It could be just a regular savings account at the bank, or a TFSA with some cashable investments that you can liquidate if you need it. But it can also come from a line of credit, including a home equity line of credit. So the benefit of the home equity line of credit is that you can get a lower rate than a regular line of credit because it is secured against your home. And that's a nice way to have access to some extra cash if needed. Using a line of credit is creating debt if it is needed, but that allows your equity to grow while you don't need it. And that way you don't need to have it locked up in some safer, more guaranteed investment that isn't earning much. And that can be, pretty bad if you don't need the money for a long time. You sort of just have this chunk of money that's always not really earning much, just in case. So the home equity line of credit can sometimes make sense. Life insurance can also be sort of used for emergency savings, especially policies like disability insurance policies. That's an emergency where the policy could kick in and really help you out, because one of the main emergencies you can think of is losing your job or becoming disabled and whatnot. So there are certain insurance that can help you protect against that. Next, we'll take a look at the time value of money formula. So it is one that you all probably know. It was definitely brought up in the Canadian Securities course, and it is just a general business finance formula that people know. So it is the present value equals the fair value divided by 1 plus the rate of growth. And so you can either use the formula when doing the solutions, or you can use a financial calculator and punch in the numbers in the required fields. So a quick example of the time value of money formula. So you have some clients, they have the objective to save $50,000 by the end of 10 years. So you know that the fair value is $50,000, and the time period, it's 10 years. The couple earns 3% compound interest on monthly savings. So now you know that they're going to be saving monthly. So the time period is not 10 years, it's 120 months. So that's why N equals 120. Your interest rate, it is the 3% divided by 12. So whenever there's an interest rate, it's always the annual rate. You'll just want to convert it to a monthly rate by dividing it by 12. And it says net of inflation and taxes. And so they're putting that money into savings at the end of every month. So using your financial calculator, you can just plug in 50,000 fair value, 120 for the time period, which is N, the interest rate 0.25, and the present value is 0, or you can just leave it and just solve for the payment. And so you know that they need to save $357.80 per month throughout those 10 years to get $50,000 at the end of the 10 years. So we'll tie it all back to the learning objectives. We went over the net worth statement and how to calculate all of that. We also touched on cash management and the cash flow statement, discussed some saving strategies and how you should maybe recommend it to a client. And then just went through the time value of money formula using a financial calculator. So it is pretty straightforward. This chapter, it is weighted fairly heavily on the exam, so although there aren't too many learning objectives, it's pretty important to know them all really well. I really hope you found Chapter 4 helpful, and I'll see you all in Chapter 5.